Understanding the Producer Price Index, or PPI, is like getting a sneak peek into inflation. It's a crucial economic indicator that helps us understand the cost pressures faced by producers. It measures how much businesses are paying for things they need to make their products or provide their services. This includes everything from raw materials to finished goods. Think of things like raw materials, energy, and packaging. These are essential components that businesses rely on to operate efficiently and produce the goods we use every day. The PPI is a leading indicator. This means it can give us clues about where prices might be headed for consumers in the future. By analyzing PPI data, we can anticipate inflation trends before they fully materialize in the consumer market. This means it can give us clues about where prices might be headed for consumers in the future. If businesses are paying more for their inputs, those higher costs often get passed along to us, the shoppers. If businesses are paying more for their inputs, those higher costs often get passed along to us, the shoppers. This can affect everything from the price of groceries to the cost of manufactured goods. The Bureau of Labor Statistics, or BLS, releases the PPI data every month. This regular update allows economists and analysts to track changes over time and make informed predictions. It's a big deal for economists, investors, and policymakers because it helps them understand the direction of inflation and make decisions based on that information. They use this data to shape economic policies, investment strategies, and business plans. In short, the PPI is a vital sign for the economy. It provides a snapshot of the economic health and helps predict future trends. It's worth keeping an eye on. By understanding the PPI, we can better grasp the economic forces at play and make more informed financial decisions. The latest PPI report from the Bureau of Labor Statistics showed that inflation at the wholesale level is continuing to cool down. That's the good news. The PPI rose by a modest 0.1% in July 2024. That's less than economists were expecting. It suggests that the inflationary pressures we've been seeing might be easing. Looking back a bit further, the annual increase in the PPI was just 0.8%. That's the smallest jump in nearly 3 years and a significant drop from the peak we saw in 2022.
The stock market, as it often does, reacted to the PPI news with cautious optimism. Investors tend to like it when inflation shows signs of slowing. The Dow Jones Industrial Average, a key stock market index, inched higher after the PPI report was released. The S&P 500 and the technology-heavy NASDAQ composite also saw modest gains. Why does this matter? When inflation is under control, the Federal Reserve is less likely to hike interest rates. Higher interest rates can make it more expensive for companies to borrow money and expand, and can put a damper on economic growth.
Remember how we said the PPI is a leading indicator? Well, the Consumer Price Index, or CPI, is its close relative. The CPI measures the change in prices paid by consumers for a basket of goods and services. Think milk, bread, gasoline, rent, and haircuts. The PPI and CPI are connected. When producers face rising costs for things like raw materials and energy, they often pass those increased costs along to consumers in the form of higher prices. That's why the upcoming CPI report is so important. It will give us a clearer picture of whether the slowdown in producer price inflation is actually translating into relief for consumers' wallets. Section 5. Expert Voices Analyzing the Inflation Puzzle. Economists have been weighing in on the latest PPI numbers, and many see it as a positive sign that inflation is on the right track.
Lydia Boussour, an economist with Oxford Economics, noted that the PPI data reinforces our view that inflation will continue to moderate in the coming months. She pointed to easing supply chain pressures and cooling demand as factors contributing to the slowdown.
Andy Schneider, an economist with Moody's Analytics, echoed that sentiment.
The PPI report is another sign that inflation is moving in the right direction, he said. He added, however, that it's too early to declare victory.
Section 6. The bigger picture: jobs, interest rates, and the Fed. The PPI report doesn't exist in a vacuum. It's just one piece of a much larger economic puzzle.
The Federal Reserve, the central bank of the United States, has been aggressively raising interest rates in an attempt to bring inflation under control. These rate hikes are designed to cool down the economy and slow down inflation.
The job market is another crucial piece of the puzzle. The recent jobs report showed that the U.S. economy added a healthy number of jobs in July. That's good news for workers, but it also suggests that the economy is still running hot, which could make it harder to tame inflation. Section 7, what's next? Inflation outlook and policy implications. The big question on everyone's mind is, what does this all mean for the future? With inflation being a critical economic indicator, its trajectory will significantly impact both policy decisions and everyday life. The slowdown in PPI inflation is encouraging. It indicates that some of the pressures driving prices up might be easing. It suggests that the Federal Reserve's interest rate hikes might be starting to have their intended effect. These measures are designed to cool down the economy and bring inflation back to manageable levels. But it's too soon to celebrate. The economic landscape remains fragile, and premature optimism could lead to complacency. Inflation is still higher than the Fed would like it to be. Persistent inflation can erode purchasing power and savings, making it a significant concern for policymakers. The Fed will be watching upcoming economic data, including the CPI report, very closely as it decides whether to continue raising interest rates or to hit the pause button. These decisions will be crucial in shaping the economic outlook. The path of inflation in the coming months will depend on a variety of factors, including energy prices, supply chain disruptions, and consumer demand. Each of these elements can significantly influence inflationary trends. It's a complex picture, and there's still a lot of uncertainty. Navigating this landscape will require careful analysis and strategic decision-making from both policymakers and businesses. Section 8, your wallet on the line, practical impacts of slowing inflation.
Okay, but what does all of this economic jargon actually mean for you and me?
If inflation continues to moderate, it could mean some relief from the price pressures we've been feeling.
We might start to see smaller increases in the prices of groceries, gasoline, and other essentials.
However, it's important to remember that slowing inflation doesn't necessarily mean prices are going down. It just means they're not going up as quickly.
And some prices, like those for housing and services, remain stubbornly high.
So, while the latest PPI report offers a glimmer of hope, we're not out of the woods yet when it comes to inflation. Section 9, a deeper dive into PPI components, energy, food, and more. In this section, we will explore the various elements that make up the Producer Price Index, or PPI, and how they influence the overall economic landscape. The PPI isn't just one big number, it's a composite of several categories, each providing insights into different sectors of the economy. These categories help us understand price trends across various industries, from manufacturing to services and everything in between. For example, energy prices have been a major driver of inflation in recent months. The cost of oil and gas can significantly impact the overall PPI. The PPI for energy goods has been particularly volatile, reflecting the fluctuations in global oil and gas markets. This volatility can be attributed to geopolitical tensions, supply chain disruptions, and changes in demand. Food prices are another crucial component of the PPI. The agricultural sector plays a significant role in determining the cost of food products. The cost of agricultural commodities, like wheat and corn, can have a big impact on the prices of food products we buy at the grocery store. Weather conditions, crop yields, and global trade policies all influence these prices. By looking at the individual components of the PPI, economists can get a more nuanced understanding of the forces driving inflation. This detailed analysis helps policymakers make informed decisions to stabilize the economy and control inflation. Section 10, Historical Perspective Inflation Trends Over Time. To understand where we are with inflation, it's helpful to look back at where we've been. The United States has experienced periods of both high and low inflation throughout its history. The 1970s, for example, were marked by runaway inflation, while the 1990s and 2000s saw relatively stable prices. The current bout of inflation, which began to accelerate in 2021, is the highest the U.S. has experienced in decades. Understanding historical inflation trends can provide context for our current situation.
Section 11. Global echoes inflation in a connected world. Inflation isn't just a US problem, it's a global phenomenon. Many countries around the world are grappling with rising prices. The causes of inflation can vary from country to country. In some cases, it's driven by supply chain disruptions caused by the pandemic or the war in Ukraine. In other cases, it's fueled by strong consumer demand or government spending. The interconnectedness of the global economy means that inflation in one country can have ripple effects on others. For example, rising energy prices in Europe can lead to higher costs for businesses and consumers in the United States.
Section 12. The road ahead: navigating uncertainty in uncertain times. We're living in an era of unprecedented economic uncertainty. The COVID-19 pandemic, the war in Ukraine, and other global events have created a complex and rapidly changing economic landscape. The path of inflation in the months and years ahead is uncertain. It will depend on a multitude of factors, many of which are beyond our control. What we do know is that inflation is a serious issue that affects us all. By staying informed, making smart financial decisions, and demanding action from our leaders, we can navigate these challenging times.